pleasure to introduce our keynote speaker, John Doyle. As Executive Vice President of Chartis Incorporated and President and CEO of Chartis U.S., Mr. Doyle oversees the company's commercial property casualty businesses and its private client group in the U.S. and Canada. Thank you. After graduating from SUNY Buffalo, he first joined AIG in 1986, working at its subsidiary National Union. Over the years, he held executive positions in several facets of the industry, including management and professional liability, excess casualty, workers' compensation, and field management with AIG's domestic commercial property casualty companies. John served as President and CEO of National Union, President and CEO of American Home Assurance Company, Executive Vice President of AIG's Domestic Brokerage Group Field Operations, and Senior Vice President of Domestic General Insurance. In addition, he is an active member of his community. He serves on the board of the New York Police and Fire Widows and Children's Benefit Fund and is a member of the Dean's Advisory Council for the University of Buffalo School of Management. Please join me in welcoming John Doyle, Executive Vice President of Chartis Incorporated and President and CEO of Chartis U.S.
Not as good as Bruce, but you know. Not often a couple of UV guys get up here, Bruce, right? Congratulations to all the award winners. Mort, where's Mort? I've been 25 years at AIG, and I finally found somebody who made me feel good about my starting salary. So thank you for that. It's great to be here. It's really a privilege to speak to all of you. I always enjoy speaking to, not trying to be gratuitous here, I'll try to tie it in a second, but to speak to PIA agents. You are professionals, you're entrepreneurs, you're really what we try to do in a very, very big company. I'm sure my colleagues have heard it from me many, many times. I ask them to act like owners of the business. You own your businesses, you grow your businesses, you are true business people. That's how we want our people to operate. So it is a privilege to be here. I'm also, I want to thank everybody. I try to do this when I chat with our producer base, but I want to thank all of you for the support over many years, but particularly over the last couple of years. We certainly tried, put some challenges in front of you in terms of the way you transact your business. It's never good when you put your distribution base or your customers in a position to have to defend your exposure to us, and we know we did that. So we thank you for your support. Pleased to report AIG and Chartis continue to make great progress in its restructuring efforts and its ability to repay both the Fed and U.S. Treasury. Hopefully you've read quite a bit about that. It'd be hard not to read about it, but hopefully you've had a chance to catch up. And again, I'm happy to take questions as we go along here this afternoon about that or any other subjects. So at the risk of giving everybody indigestion here after lunch, I was asked to talk a little bit about the market, my thoughts on the market, where I think it might be headed, and then on top of that, really how we're managing through this challenging cycle in the market. So I'll do that. Again, as I said, you got a question in the middle, you want me to jump? You want to jump in, please do. Or I'm happy to take questions at the end as well. So truly challenging times for us as a P&C industry in the United States. Current accident year results, not good, right? Not good really, kind of by any measure, probably for the industry somewhere in 107, 108 combined ratio for 2010 with loss cost inflation, growing expenses. The likelihood of that number climbing in 2011, I think, is high. So clearly a challenging time. In this investment environment, this economy does not add up to a good return overall for shareholders and property casualty companies. Having said that, we're, as an industry, still living off the benefits of the past. Calendar year results have been buffered by prior year development, favorable prior year development, although we're starting to see that favorable prior year development decline in a pretty meaningful way. My guess is that most companies, and maybe for the entire industry, that favorable prior year development will dry up during the course of 2011. It's also the 6th consecutive year that prices are declining, and while prices at our company are relatively flat, down very slightly, again with loss cost inflation, continued pressure on the underwriting results for the industry. So what do the rating agencies think of that? S&P, AM Best, Moody's, all have a negative outlook on our industry. So again, clearly challenging times. So let's talk about why. As you all know, or most of you know for sure, our business is largely about supply and demand. While we operate in many different markets around the world at Chartis, many different products. We have over 450 products and services around the world. About half of our business outside of the United States. I think it's important to take a step back and look at the big picture. Why is there a supply-demand imbalance at the moment, and how and when is that likely to change? So if you look at supply, and a measure of supply for sure is the amount of surplus supporting the industry here in the United States. Over $550 billion worth of surplus at the end of the third quarter supporting the U.S. business. A record amount of surplus. Why is that? Well, it wasn't this high a year ago or 18 months ago or even 2 years ago. Typically in a softer market you might begin to see some of that capacity decline. We have yet to see that. Really when during 2009, beginning really in the second quarter, late in the second quarter of 2009, as financial markets and credit markets began to recover, the asset side of the balance sheet of the industry began to recover as well. That had an inflationary effect on the supply, the capacity that we have, the surplus that we have to provide insurance to all of you and to all of your customers. In addition to that, a bunch of new capacity came in the first half of 2009. Why? Probably betting on our failure, betting on the failure of a few other companies that were struggling through the credit crisis as well. So, yeah, again, the impact of the recovering credit markets on top of that new capacity that came in at what, in my opinion, now appears to be a very bad time for the marketplace. All that leading to a record amount of supply. So, where's the demand side of the equation? Well, unfortunately, that's headed in the wrong direction as well. And it's really largely tied to the economy. 80% of our business at Chartis in the United States is commercial insurance, right? That may surprise some of you. We do a bit more consumer business in the U.S. than I think most folks realize. But 80% of our business, again, is commercial related. And really, the demand side, to me, the key indicator for demand in the commercial insurance space is unemployment. As long as unemployment remains relatively high, and it certainly is high, to me, demand for our commercial insurance product will remain relatively low. John and I we're starting to see some signs, some new construction during lunch, but those opportunities are kind of few and far between in this economy. No one is really predicting a kind of great recovery in terms of jobs during 2011. So my sense is that demand for commercial insurance during 2011 will remain relatively low. On the consumer side, it's a bit of a different story. We're, as I said, about 20% of our business in the United States is consumer-oriented. It's in a couple of niche areas. We have a high net worth personal lines business. We do a bunch of business with a number of you in that space. We also have an accident and health, a large growing accident and health business as well. And on top of that, we have an extended warranty business. So we are seeing some signs of increased demand on the consumer side of our business. I'm happy to report that. And we have a bit more pricing power in that segment of the business as well. So things appear to be in a bit of a better spot on the consumer side. When I mentioned S&P, AM Best, and Moody's opinion on the market, I was talking about their view of the commercial P&C space. They do have somewhat differing views on the personal line side of the business here in the United States, but nonetheless, the pressure overall on the market is pretty significant. So what are we seeing in terms of increased demand? In our high net worth personalized business, we're seeing wealthy people acquire some assets again. Historically, that had been a source of growth for us in our renewal base. Wealthy people would acquire more assets. We'd add that to our policy, and we'd see real growth from our personalized portfolio that way before we added new exposure to the portfolio. That didn't happen in the second half of 2008. That didn't happen in 2009. But we've begun to see some recovery. It's not what it was in 2005, 2006, and 2007. But again, we're starting to see wealthy people spend some money again and acquire new assets. So a great sign, really, about the economic recovery overall. Accident and health. We play in a lot of different areas of the accident and health market. A big source of business for us is in the travel space. People are traveling again, spending money on travel again. It was a big growth area for us during 2010, so I'm happy to report that. And then the extended warranty business. We're largely in that space in the consumer electronics area. So if you've been in Best Buy, I talk to my team about this a lot, but if you've been in Best Buy and they're hassling you to buy that extended warranty, we're not hassling you, but we take the risk for years 2 and 3 on that. And as I've shared with some other folks in our business, while people may be out of work, they're buying plenty of iPads and iPhones and buying warranties. So a mixed bag from an economic point of view. We're seeing some recovery on the consumer line side, as I said, and the commercial line side continues to be very, very challenging. My opinion, that imbalance is likely to continue. The credit markets and financial markets have stabilized quite a bit, so it's unlikely for us to see a significant change in the supply, and I don't think the economic recovery will be that robust that it would drive the supply side of the equation. So when you think about the pricing, when you add all that up, what does that mean to the pricing environment for 2011? Unless we see some level of discipline in our business that I certainly haven't seen in my 25 years in the business, my sense is that the business will remain somewhat competitive during 2011. So I'm so sorry, that's part of your indigestion here at lunchtime. So supply and demand, we talked about that. Can we make it up on the investment side? I wish that were the case. Really low interest rates, central banks trying to spur economic growth around the world, also here. So low interest rates, P&C companies also looking to de-risk their investment portfolios. Our industry fared very, very well throughout the credit crisis, but nonetheless, P&C companies have de-risked, have moved away from alternative investments in a pretty significant way, right? On top of that, there's a lot of pressure on the muni portfolio at the moment. There's going to be some unrealized losses coming through the GAAP financials during the fourth quarter as you see companies report the results on their muni portfolio. You may have seen Meredith Whitney, of fame from predicting big elements of the credit crisis, was on 60 Minutes forecasting the demise of the muni market in a very significant way. So with companies de-risking, with low interest rates, and the likelihood, while interest rates will obviously increase, and we all need to be aware of inflation and how it impacts our business over time, the likelihood of a significant increase in the investment portfolio from interest rates coming out during 2011, I think, is also very, very unlikely.